And welcome to the Real Estate edition of That Business Show 2.0. I'm your host, Jamie Maloney, where real estate becomes show business, with new episodes each Thursday, 9 a.m. Eastern Standard Time, thatbusinessnetwork.com. Today, we're going to be talking about crowdfunding with Alan Lewis, who is my guest. He is the Chief Investment Officer and co-founder of DiversyFund and has worked in the real estate industry for 15 years, including heading up a real estate private equity division where he oversaw Class A multifamily and working on Wall Street as both an investment banker and a corporate attorney serving real estate investment clients. So, Alan, welcome to the program today.
Hey, thanks, Jamie. Appreciate you having me on.
You know, crowdfunding is a term we're hearing more and more about in business, and I've talked about this on the program before. So before we get into it, for the people that aren't familiar with what crowdfunding is, give us the overview of what crowdfunding is.
Sure. The term gets tossed around quite a bit. There's some technical terms for crowdfunding, but essentially when we in the industry talk about crowdfunding, it means having a crowd of investors. So think of a group of investors spread across the country, from California to New York and all the states in between, who are basically coming together, pooling their money in order to fund a particular transaction, be it real estate, or we've all seen the startup companies that had crowdfunding like Kickstarter. So basically a crowd of investors pooling their capital together to make some sort of investment or transaction happen.
Now, why are we hearing about this more and more? There was a recent change that allowed the average person to participate in crowdfunding. What's the history of this?
Sure. Yeah, it all stems back to the Jobs Act, and there's some different parts of it. There's Title II, which is what most of our deals fall under, which allows people for the first time to advertise potential transactions. So before that, you had to have a prior relationship with someone. You couldn't just advertise saying, "Hey, we're raising money for this project or this transaction." So now we can do that as long as those investors at the end of the day are all accredited. It's the new 506C exemption for the securities laws. The new thing that everyone's hearing about is the new Title III, which is crowdfunding, where startup companies can raise up to $1 million. So definitely has a big limit on it. And there are some limitations as to how much an investor can put in based on their net worth or income. And so that's the new thing that just came online, became active about a year ago. And so that's been the big buzz in the news. The older 506C has been around for a couple of years.
So what is DiversyFund? What are you investing in?
So we are an online crowdfunding platform. And what we've done is we invest in real estate. We looked at the market, and what we saw is as crowdfunding sites started popping up, there was this huge demand for real estate, right? Because if someone's going to invest, they want to have, it's beneficial to have a hard asset, backing your dollars, right, instead of just investing in a startup company and rolling the dice at the end of the day. So what we looked at is all the competitors out there were functioning as a broker, right? They were matching investors to various third-party real estate developers and real estate sponsors. And we had some problems with that model because you have no quality control, right? I mean, you're gonna have some great sponsors, you're gonna have some not so great sponsors, and you're not gonna know the difference until it's too late and investor capital is at risk. So, with my career having come from, real estate development background, and my partner having done real estate development for his 20-year career, we said, hey, let's just do something totally different. Let's go vertically integrated, where all the offerings that we put on our platform that our investors can look at, we're the developer on all those. So we have this quality control. We have a general contractor construction management team license that's on board in-house. And it's just been a huge switch in business model that makes it better for our investors at the end of the day.
Okay, so you're the developer behind all the projects that are in the fund. So you're not buying third-party assets and putting them into the fund or becoming involved in those?
That's right, exactly. And so it's better for both sides, right? I mean, we have, if I'm doing a project, it's here in my backyard in San Diego, we can visit it on a weekly or monthly basis. And the minute it's off schedule or over budget, we know, and we can jump in and fix it rather than relying on someone else to, hopefully tell you that something's not working out.
What type of assets are you developing right now? Are you commercial assets? Are you doing residential, single family homes? What's doing well in California where you're investing?
Sure. We have two main product lines that we like right now. We're always looking at market metrics to see where the trends are heading, what's happening with sales prices and rental rates and vacancy. So right now we have single family residential products that we're building. We're doing, these high-end homes in places like Coronado and La Jolla. And there's just such a healthy profit margin on those that's worked out really well for investors. Excuse me.
So what keeps values, so high out in California? We all know about Silicon Valley and the tech industry out there. Is that still what's keeping values, so high out in California?
Yeah, a lot of it's just, if you come and visit, you see that the weather, you can't beat it. So
Right.
it's just people want to live here. And so we always have population growth and job growth. Down in San Diego, we're benefiting from a lot of, venture capital, type startups starting to look for a cheaper place to live that's still in a desirable location for young professionals.
California, a very expensive market, but a very desirable one, no doubt. I was in San Diego a couple of years ago, and I think the starting price for a home is like $500,000. I mean, I'm in Tampa, major metro, and you can still get a starting home for $100,000. It amazes me the differences in prices across the metros. I guess it comes down to the weather out there. I mean, we got heat, but we got that humidity. You don't got that humidity out there.
Yeah, we don't have the humidity, which is nice. And yeah, it's just such an appealing place to live that people have really been steadily coming here.
Tell me how this differs from like an electronic real estate investment trust, an REIT, for instance. And also, how would one who wants to invest be able to invest? Do they have to be an accredited investor, as we know that term?
Sure. Yeah. For our platform right now, all of our investments are targeted for accredited investors. Our minimum investment is as low as $10,000, trying to make it very easy for someone to get started. The E-REITs, the electronic real estate investment trusts that we're seeing out there, are similar to what we do with our passive income fund. What that means is that you're basically creating a fund, and that fund invests over a large number of real estate assets. So you have the benefit of diversification. So if one particular project doesn't work out, instead of just being, in dire straits with your capital, you have this pool of investments to kind of spread that risk out. And so it's a very easy way for especially new investors into the real estate space to get started. Our passive income fund, similar to a REIT, distributes out each quarter all of the income and interest it earns. So we've been basically hitting about a 11.4% average return net to investors since we started that fund about 4 years ago. So very established track record. And people basically just put their money in, and each quarter they get a check, and then after their initial 2 years, they can pull their money out whenever they want.
How has real estate been performing in California? In Florida, for instance, we had a great run up until 2006, and we had that terrible crash. We lost about 50% in value across the board between 2006 and 2008. And really, we didn't start to recover until 2012. And we've probably picked up about 30% of that lost value back, on average. How has the California real estate market performed? And that's the residential market.
Sure. Yeah. In the residential, I mean, we didn't take quite as deep of a crash as you saw like in Vegas and Florida, Miami, where you had a lot more speculation. Pricing, is pretty much on par with, has fully recovered. Right now, we have great year-over-year price increase. I think it's anywhere from 6 to 10%, depending on the price point tier. But even then, if you look at the sales volume, I was just pulling up these statistics. In fact, back at the peak in 2004, your monthly sales volume down in San Diego, where we're at, was about 76,000 homes trading per month. And then the low point back in 2008 was 19,000. So it drops from 76,000 down to 19,000 per month. And right now we're currently at about 46,000. So somewhere in the middle. So we're still not even hitting the same volume, which is good because we don't have as much speculation going on, but pricing is pretty much recovered.
Hold that point there. I got to take a quick break. Currently talking to Alan Lewis, Chief Investment Officer with DiversyFund, using crowdfunding then to get you into the real estate business with a professional group that understands how to invest in the real estate market. Learn more at DiversyFund.com. We got more with him when we come back from the break on That Business Show 2.0, the Real Estate Edition, with Jamie Maloney, where business becomes show business. we're back to That Business Show 2.0, the real estate edition, where real estate becomes show business, with new episodes each Thursday morning, 9 a.m. Eastern Standard Time, thatbusinessnetwork.com. Today, my guest is Alan Lewis, Chief Investment Officer with DiversyFund, where they're using crowdfunding to invest in real estate assets. So if you're an accredited investor, want to get into the real estate business, a nice tangible product that protects your investment, visit DiversyFund.com for more information. So Alan, how is like the residential market and commercial market, are they connected? When one goes up, one goes down, when they both go down, they both go down? What I'm kind of getting at here is, how is exposure, or how is my money, at risk when I'm investing, in just real estate assets in California?
Sure. Yeah. I mean, in general, if you have, appreciation or softening in the real estate market, it washes over most asset classes. However, different product types within real estate, are affected differently. So, for example, when we had, a big crash in '08 with residential, multifamily actually wasn't hit as hard, right? Because you have a lot of people getting foreclosed, and so now they become renters. And we're also seeing this perpetual renter mentality among the millennials, who just are jaded on the home buying story, and they don't want to be tied down to a mortgage and like to be able to pick up and leave if they want, on a yearly basis. And so multifamily, surprisingly, didn't have as many foreclosures as the residential side. So that's why it's always good to try to diversify yourself, over a couple different product types within the real estate asset class itself.
How is the profit margin on rentals? In 2012 in Tampa Bay market, we were sitting on record low values and record high rents, and we had this surge of investment groups that came into our market, the hedge funds, the Blackstones, Progress Residential, which was Frio, Florida, which is a Goldman Sachs based fund. They descended on our market and they gobbled up every short sale in sight. And really that's what's led to, in our market today, a very low inventory supply, because this stuff is tied up in rental housing, which would normally be coming on and off the market through normal, life events like divorce and job change. We're having a hard time finding anything to sell to anybody right now because of this. Did you have a similar experience out in California, or, and just what is the rental market like out there in terms of profitability?
Sure. Yeah. I mean, we didn't, because we had less, there certainly was speculation here in Southern California, but because it wasn't as extreme as in your neck of the woods, we didn't have, quite that opportunity. But yeah, 2010, 2011, there certainly were a lot of institutions sniffing around, gobbling up assets, for really attractive cap rates. Now what we're seeing is, especially in San Diego, in our backyard, where we also do multifamily investments in addition to our single family product. And so we have a couple of factors that we're really excited about. First of all, rent increase is right about 8% year over year, which is very high, and we like that. And vacancies are down to 3 to 2%, depending on who you're talking to. And the thing that's driving that, if you go around and drive around some of the neighborhoods, you will see a ton of multifamily construction. So your initial reaction is, okay, it's getting overbuilt, overheated. But when you go, we're big data guys. So when you go to the data behind it, the economic forecasters are showing this huge 30,000 to 50,000 undersupply deficit of multifamily apartment units that the city needs based on population and job growth. And we're only putting about 5,000 units online per year. So a huge delta between 30,000 undersupply and 5,000 units, which that's going to keep the rental increase and the vacancy rates where they are. They may level off a little bit, but I think we'll still have a very attractive outlook for multifamily here.
One of the things I loved about San Diego was the downtown, the gas lamp district, and the Petco Park that's down there. And to what degree does the downtown, a vibrant city life drive the surrounding communities? Because I ask that because downtown Tampa is a doldrum of a development. We've got some stuff on the horizon, with a new developer in Tampa that's really supposed to bring back, the nightlife and the pizzazz of the area. But to what degree does a solid, fun downtown help to prop up real estate values?
Sure. What you're referring to that's become a big driver behind making rental, in downtown areas attractive is what we call walkability, right? People increasingly, are active, and they like the fact that they can go from their front door of their apartment building to their dry cleaner, their deli, a good grocery store like Whole Foods. and restaurants and trendy bars, and have all that within just a few blocks. And so for downtowns that have been forward thinking and have zoned and done entitlements correctly to allow for that, they're really seeing that come to play. San Diego's done a great job in being forward thinking in a lot of these areas. The Gaslamp in particular actually is more catered towards convention visitors that come and stay in the hotels in that area. So local residents tend to avoid the Gaslamp. That's kind of like Times Square in Manhattan, where I used to live. But yeah, it's certainly that walkability is a huge factor.
It's the live, work, and play mentality. And right now, downtown Tampa shuts down at like 5 or 6 o'clock in the evening. There is no nightlife in downtown Tampa. But we've got an investor, Jeff Vinnick is his name, and we got this district called the Channelside District, which is supposed to be a very vibrant area, which has done poor over the last 10 or actually 20 years or more that it's been in existence. He's wiping it all out. It's waterfront community. He's building this brand new development. So everybody's all about downtown Tampa right now. So we're very excited about what's coming to the area. But one thing that we're also very excited about is the potential to get the Tampa Bay Rays Stadium over to downtown. And you all have Petco Park downtown. When that came downtown, was there a notable increase in activity downtown?
Yeah, certainly. I mean, you get a lot of folks coming in from the surrounding, suburbs for those games, and so then you have an uptick in retail, for the area surrounding the park. Of course, the local residents aren't too happy with the parking and the crowding that comes in, but it's just a great luxury to have a ballpark just a few blocks away that you can go visit. Especially if you're a baseball fan.
How do you see your fund, DiversyFund, expanding, or do you plan to stay within the California market? Do you have plans to enter other real estate markets and develop this crowdfunding platform?
Sure. Since we're the developer on all of our projects, we prefer to do deals that we're in markets where we understand, the trends and what's driving the growth and other factors. So California is an easy one for us because it's right here for in our backyard. But that said, we're certainly looking right now at other markets. I spent some time in Salt Lake City area where I headed up real estate private equity division, and a lot of similar attractive market metrics there. So we're looking at other areas where we really like what the market's doing.
And how are you attracting investors to your fund? How do you reach those people?
Sure. Yeah. I mean, we do a lot of digital advertising, on Google, Bing, Facebook, social media. A big thing for us is just educating people. The average investor is doing what my parents and my grandparents did, which is put all their money in the stock market, stocks and bonds, because that's what they've been told to do. And so they don't even realize that their investment portfolio is missing real estate, private real estate. And so we have to educate people and help them understand, a good 20 to 30% of your portfolio should be in alternative assets, which just means basically any asset class that is an alternative to investing in stocks. Of course, the biggest one is real estate. So as we go through that process, it takes a few touches, through advertising for people to finally get that message, like, oh, I need to start moving some of my money out of stocks and into real estate to be better.
I was coached, as a youngster, buy a home as soon as you can, buy as much real estate as you can by my father, because that's the road to wealth. And then we had this financial crisis that hit in, the mid 2000s. And so the millennials have a different viewpoint because of what they've seen happen to their parents and grandparents. Do you find it's a different discussion when you're talking to millennials about, the value of investing in real estate versus the baby boomers and people that have seen such good years in real estate?
Absolutely. Yeah. The baby boomers, they understand, we had a nasty downturn, but they've also seen, through several cycles, they've seen the wealth that's been generated through real estate and see that it's a great place to put some of your, allocate some of your portfolio. With millennials in general, we're seeing kind of two different groups. We're seeing those who are reading the Rich Dad, Poor Dad, Robert Kiyosaki books, and understand that real estate, is a key driver for wealth generation. We have a lot of millennials who it's just, saving for retirement isn't on the radar. It's the Instagram generation. They're just big on experiences. They're not buying assets. They don't necessarily want, the shiny car and the house. They just want these experiences. And, at the end of the day, we're trying to help them see how, if you like, being able to travel and having this freedom, starting to invest in an early age certainly will help you to maintain that ability and increase your ability to do what you want and have that financial freedom.
But on the flip side, you're reaching the millennials because you're the developer. You're building, these multifamily rental, this housing to attract the millennials who are all about the experience. And so now on the flip side, you're catering to them at least as a product provider. How are you developing your products, or are you developing your products to reach the millennials?
Sure. Yeah, I think a big part of that is, our real estate assets are the same regardless of, who our investors are. But a big part of that goes back to, educating through our marketing process. And so, when we have people, they come to our website, they sign up for a free account, and then they can start talking to our investment analysts on the phone to go through questions they have just about, asset in particular. But a lot of folks, start with basic questions of, tell me how real estate investing even works. And so we spend a lot of time with basic concepts that you're familiar with, like passive income. What does that mean? I mean, some people just have to figure out for the first time that you invest in real estate that's throwing off cash flow, and then they collect, a quarterly payment. That's new to a lot of people.
You've been involved in investing in real estate and business for some time now. Crowdfunding, a fairly new concept in business. How has it, enabled you to grow as a business? What has crowdfunding done for you as a fund?
Crowdfunding it's been a complete game changer, right? I mean, we are at the forefront of this industry that is innovating two things. One, the way capital is raised, the financial industry, and two, the way that real estate development is getting done. And so in the past, I mean, unless you knew, some broker on Wall Street and had enough money to get his attention, right, a couple $1 million, or were best friends with the real estate developer, people just didn't have access to these kind of vetted institutional quality private real estate deals. And so with crowdfunding, what we've done is we've changed the whole space and give, someone in Ohio that would never have an opportunity otherwise, we give them access. And so we talk about democratizing access to these wealth generating opportunities. And it's really what we're doing. And so as a company, it's something we're very proud of, right? To be part of changing and uprooting an entire industry and system and doing it in a way that spreads the way people can generate wealth and who can generate wealth. Now it's open to everyone.
I'm thinking of the analogy, then crowdfunding is to the average investor what podcasting is versus the media. Podcasting is giving a voice to so many average people who have built up tremendous audiences, and it's kind of the thorn in the side of traditional media out there, which doesn't give a voice to a lot of the average ordinary people. Crowdfunding in your business is giving a chance for the average person with just average money to get involved in investments that otherwise would be held off for the multimillionaires up on Wall Street. Is that a good association?
Yeah, and to the same point, I mean, you talk about being a thorn in the side of an established industry. With our income fund that's been around for a while, we've put on the website for the first time and let new investors come in. And what we did is our marketing. We talked about declaring war on fees, declaring war on the asset management fee, the performance fee that these Wall Street funds typically charge. And we can do that because we make our money on the development side. So it's very easy for us to completely eliminate fees. So the investor, if the fund's making 11%, then the investor keeps 11%. And so that certainly has people in the established financial industry not happy that fees are going away. They like their fee checks. But that's the whole, that's what happens with industry innovation. And when you vertically integrate, you have that savings, and so you can pass it along to the consumer, which in our case is our investors.
Is there a minimum investment to get involved with the DiversyFund?
Yeah, we'll go as low as $5,000. It depends on the particular project. The ones on our website right now are all $10,000. So the big one that people start with is our income fund. It's the easiest one. They just they have a 4-year track record and just park their money and collect their quarterly payment checks. We're averaging about 10.1% based on our last quarter payment. So it's a great place to start.
So if somebody wants to put some money in DiversyFund, how would they get started? What would you advise them to do?
You just go to the website, DiversyFund.com, and so they sign up for a free account, look at what we have there, and then if they want to call in and talk to one of our analysts, we're happy to answer any questions. And then the process is completely online, fully automated. You sign your docs online and ACH your capital in, and then just collect the checks.
All right, sounds good. A great discussion. Alan Lewis, co-founder and chief investment officer of the DiversyFund. Thank you so much for being with me on this edition of the Real Estate Show.
My pleasure, Jamie.
DiversyFund.com for more information. Stay tuned. We'll be back in a moment.